Thank you. Very good morning to my friends in Kuwait, and good afternoon to my friends in India. And I don't know about the other time zones. I am M.R. Raghu, Head of Research, Kuwait Financial Center. I'm also the Managing Director of Marmor, which is a fully owned research subsidiary of Marcus. I thank the CA Institute Kuwait chapter for giving me this opportunity to interact with the members of the CA fraternity in Kuwait and other friends from other parts of the world. My special thanks to the chairman, CA Sai Devata, and also the executive committee members of the Kuwait chapter of the Chartered Accountants Institute. It's really very interesting times, I should say, a very troubling topic. We are all home arrested, mentally challenged in terms of how we face this problem. We don't know if we are at the beginning of the problem. We don't know if we are in the middle or almost at the end. So there is absolutely no visibility. So this means that the topic is very important to our lives, to our career, to our investments, and therefore I think it's a very timely topic to focus on. So without wasting further time, I expect to run this presentation for about 45 minutes. And then while you're listening to the presentation, you're most welcome to register your questions, and then I will have an opportunity to read them. And at the end of my presentation, time permitting, I will try to reflect on these questions or some of these questions and provide my views. So let's get into the presentation. And as you can see here, the idea is probably to see beyond what is happening today, which is to visualize a non-COVID world. So and also we need to see how soon we will get back to that world which we are familiar with, which we were living before, and if and when normalcy returns, how good that is going to be. So this is the sort of questions that I'm trying to answer here. So I will divide my presentation into probably three parts. The first part would be to assess the crisis per se. So how much, what is the impact of COVID from various country point of view. I would especially specifically focus on GCC because we live in that region and we work in that region, and therefore it's very important for us to get a glimpse of how does it compare. And the second part of the presentation would be to assess its impact on the broader economy, business, and capital markets. And then the third part of the presentation would focus on the future as to what would a post-COVID scenario look like and what can we reasonably expect a post-COVID scenario to shape up. These are my personal assessments, and therefore the speed with which things change even on an hourly basis, I think forecasters can go completely wrong, and that's a strong disclaimer that I would like to make right away. So let's take a look at what's really happening in terms of the global COVID cases. The coronavirus started very small in January. In fact, the first case, while official talk about this started happening in December, I think the problem started happening in November in China, It's only on December 31st that China formally admitted to the severity of the problem. And then you can see in the chart that it's not been till March 12th, it was pretty much a Chinese problem. And then you can see how it became a global problem. So what started in hundreds developed into thousands, and then today we are going to be crossing almost, I think by the time I'm speaking, I think it's already 1 million cases now. 1 million is a big number to focus on, and so far we have approximately 50,000 deaths, 200,000 people recovered, and about 3.5 million tests performed. But the chart that you are seeing here, there is a very important statistics which shows the number of cases per million. And here you can see that China is the lowest. We will come to that issue later, and you can see that Spain and Italy are the highest impacted so far from a number of cases per million persons point of view. US is getting nasty and ugly, and what is very important is to see the trend on a 5-day basis, and you can see the steep increase of that line, and so long as that line keeps in an upward trajectory, it means that we are very much in the eye of the storm. So only when you see that line straightening up and then falling, then do you know that you're slowly coming out of the problem. So this is a very important dashboard to look at. We publish this on a daily basis, and please check our website to get an update on this at any point of time. So we also see here as to what is the size of the problem for GCC. Well, if you look at the global scenario, GCC is not that big a problem. We only have about 4,500 cases so far, 31 deaths, and intensive testing across countries. But then again, you see that among or within GCC countries, you see a lot of variation in terms of number of cases per million. Bahrain tops the list, and followed by Qatar, and Kuwait is not a very bad scenario if you ask me. We have 77 cases per million population, which is not a very bad number, and Saudi Arabia also is not a very bad number. But then the problem is, we can, if you check out the individual dashboards, Saudi is definitely on an ascendancy, which is going to say that it can get problematic as we step into the future. Let's look at Kuwait. We have 317 cases with no deaths so far, and good amount of recovery, but then very, very strong testing, about 17,000. So you can see that the 5-day new case trend is somewhat volatile with ups and downs. So it's not a straight upward sloping trajectory. So they are containing the problem, and if you even look at the long-term evolution of cases from 24th of Feb to about the 1st of April, I think it is a very gradual evolution rather than a sudden spike that you see in many other countries. How is the scenario in India? India, so far, it surprises me to see that we have a very few number of cases. Maybe we have a problem in terms of capturing the actual data for a 1.3 billion population. It cannot be just this small number. We already, but even within this small number of cases, we are experiencing a higher mortality rate. We already have 56 deaths, and the amount of testing that we are doing is absolutely insufficient for a population of our size. And if you see the 5-day new case trend, you can see how steeply it is pointing in a very upward trajectory manner, and I believe that this pattern is going to be seen for some more days to come before we can flatten the curve. So this is the quick uptake of the numbers in terms of the coronavirus problem in the world. How severe is this virus compared to the earlier, viruses episodes that we had before? So you can see a very nice chart here in terms of the severity on the log scale, and how contagious the disease is. So it's COVID or coronavirus. One person who is carrying the virus can infect about 2 to 3 people. But the problem is it doesn't score that bad when it comes to the degree of contagiousness. But what is problematic here is the incubation time. So it is a virus that has one of the highest incubation period compared to other viruses or episodes that we looked at before, be it a Spanish flu or SARS or other things. So when we are talking about a very high incubation period, in this case the median incubation period is about 5.5, but symptoms can develop as late as 14 days from the exposure. So that makes it a bit deadly in terms of its impact. And also, if you take SARS as a benchmark comparison, SARS affected only about 8,000 people. COVID has already affected about 1 million people. And SARS death was only about 774, whereas COVID death as of today is hitting about 50,000. So it's not by no stretch of imagination this is a very small problem to deal with. It's a much bigger problem to deal with, both in terms of the expected fatality rate as well as the severity of the overall damage that it can cause. We saw before the very low numbers per million for China at only about 59. There are two schools of thought here. One is that Chinese, did manage to use an iron hand and contain the problem, and therefore they just escaped with a very small price. And more importantly, they had the problem confined to just one area, which is Hubei. Whereas when it started spreading to other parts of the world, especially US, you can see in the chart how US has been affected almost across the spectrum, from New York to New Jersey to Louisiana to other places. So the Chinese probably had it only in Hubei, whereas in other parts of the world, even in India, for example, we have Maharashtra, we have Tamil Nadu, we have Kerala, we have corona coming from almost all parts of India. So if you see the reported cases per million, how you can see how Chinese curve flattens like a straight line that you draw using a scale. Whereas you can see other countries have a very volatile pattern to deal with. Well, the first school of thought is Chinese did a much better job in terms of containing them, whereas the rest of the world took it a bit lightly, and therefore they are paying a higher price. The second school of thought is don't trust the Chinese numbers. They are definitely managed. They can't look neat and clean as you see here, and therefore the real damage is much bigger than what you see. In times like this, there is no depth for conspiracy theories. So I will just leave it at that. Now, what is the problem in terms of understanding what is currently happening? First of all, we are talking about a mortality rate or a fatality rate or a death rate of about 5%. That is as of today. And that compares very high to, say, for example, 0.1% for flu or 0.2% for pneumonia. But then, is this 4.7% overestimated or underestimated? We don't know. Now, there are four factors that might contribute to very differing interpretation of death rates. The first question is who becomes infected. The second question, what stage the epidemic has reached in a country. There is stage 1, stage 2, stage 3. Stage 3 is when you have community spread of the disease, which can take the curve exponential. And the third question is how much testing a country is doing. And this is the most important question to ask. And the fourth question is how well the healthcare system is coping to manage the problem. So it's a combination of all the four. And I would pick the third point, which is the testing. And you see a graph on this slide which gives statistics about tests per million of the population, where in Switzerland about 8,000 people are tested for every million population, whereas in Japan we hardly have, or in US, for example, we have a minuscule of that. So it's not I mean, unless you test extensively, you will not answer the question number one, which is who becomes infected. So when you don't have the data as to how many are infected, then probably you don't know how big the problem is. So the biggest unknown in this coronavirus is the true number of people worldwide that have contracted the virus. Again, the problem is it's not that whoever contracts the virus shows the symptoms. So they can be not showing any symptoms, and then you do not know as to how many people are under the umbrella of COVID. So the simple question is, you have the data before you, and if you want to really understand how the real number is, should you multiply this data by 3 or 300? We don't know. So, and also there is this research that shows that the proportion of COVID-19 victims who would have died anyway would be as much as half or 2/3. Remember, every day we have about 153,000 deaths in the world, and a lot can be mistakenly attributed to corona, and that again makes the statistics a bit messy. So when you look at numbers, you must take them with a pinch of salt. So this is very important. As they say that there are known unknowns and unknown unknowns, corona is definitely an unknown unknown here. Now, in terms of risks, obviously this is a very nice way to visualize who are at risk in terms of how frequently they get exposed to the disease at work, and also how proximate are they to others while working. So the frontline soldiers of this epidemic or pandemic are people like general practitioners, doctors, nurses, paramedics, and you can see them on the right side, and on the left side the most or the least affected cohorts would be the lawyers and accountants and farmers and what have you. So this will give a good idea of which sector will come under the stress, which we will look at very quickly now. So with this brief background on the COVID itself, let me jump to the next part, which is part number 2, which is its impact on economy and the business. So in terms of the economy, Now, we still don't have any estimates coming from, say, IMF, which is the most cited and referenced authority for global growth forecast, or the World Bank. But definitely, if you look at some of the publications coming from Goldman Sachs or Economist Intelligence Unit, you can see how drastically they have cut the growth forecast for various geographies. And you can see that almost all of them are now from positive to deep negative, except for emerging markets like India or China or Indonesia, which India is expected to be posting the highest growth post-corona. But still it is just 2% as against the normal 6% growth that we were expecting before. But more importantly, if you look at the past episodes of crisis where we experienced GDP negative growth, it ranged from minus 1.6% to max minus 4%. Now the corona impact is going to be for the first quarter is about 9% and minus, and the second quarter is about 34% as we speak today. And there are more scenarios which we will look at as we go along. So in terms of business impact, it's very essential to look at and zoom on some of the stressed sectors which are directly hit by coronavirus problem. Of course, the first sector to take the largest beating would be the airlines. Almost all aeroplanes in the world are grounded and are lying idle. And this is clearly seen by the share price fall in big names like Boeing, Airbus, to the extent of about 50% as we speak today. Hospitality, Marriott International occupancy rate is about 15%. Energy, the biggest company, ExxonMobil, with a $100 billion valuation, is the worst performing stock this year. And the retail sector has been hit because the footfall has come to zero. But in this process, there are some people who have been hit, but there are some sectors which benefited as well. The main sector that benefited in this crisis is the technology sector. Especially Slack users have surged by nearly 25% in just 2 weeks. Zoom, the video chat site, they have nearly doubled in share price. Facebook and Alphabet, which is Google, are benefiting from a surge in the traffic because everyone is at home and everyone is on the internet all the time. But again, there are ways to benefit and there are ways to lose. For example, Facebook and Google depends heavily on online advertising, which has come down significantly. So it's one part of the business that will benefit, but there will be another part that will be hurt. Automobiles is clearly a stressed sector. Ford has already tapped into a huge credit line. General Motors executives are taking pay cuts, and Volkswagen has requested ECB to buy short-term debt. So there is definitely no good news in automobiles as we speak. And banks will also be hit by NPAs, but they are in a better position today than when you compare them to 2007 in terms of their capitalization, especially their tier 1 capital is much better in 2019 compared to 2007. There is a nice chart which shows that aspect. So they are in a better position to take the hit as compared to, say, automobiles or aviation or hospitality. Now, the biggest problem is the supply chain. The China is the global supply chain engine for the world, and but you will be surprised to see that the number of potential supply chain disruption in China is much lower compared to US. And this is a comparison between January and March, and Germany has been affected deeply in terms of supply chain disruption. But there is one point that we need to understand here in terms of which leg of the supply chain is at present the most disrupted. So there is, for example, if you take pasta making as a supply chain, where it starts with the wheat farmer, and then it is shipped to Italy, where it is turned into pasta, and then it goes via a truck across Europe, and then it is ferried to UK, where it's put into the trucks and transported to various distribution centers, and from there it is sent to the supermarkets from where the customers buy. As of now, the panic is seen only at the demand end of the things, which means at the supermarket level. But it can quickly go into the full spectrum of the supply chain, all the way up to the farmers. If we experience, say for example, border closure, or drivers don't want to drive, and the staff in the production falls sick, and there is a disruption at ports, for example. But as of now, the coronavirus seem to have created a panic only at the demand end of the supply chain, and not the entire supply chain spectrum as we understand here. Of course, we all worry about oil price, because oil is everything for our region in GCC. Most of the GCC economies, except Dubai, are not at all diversified, so they are very highly reliant on oil. So any fall in the oil price is going to be a huge pain for the GCC economies. And oil has seen the worst fall, and we will come to that when we look at the impact of corona on markets. But what is really worrying, why did the oil go back to an 18-year low, is a combination of two factors. One, the demand destruction. Obviously, when the whole world comes to a standstill, so nobody is consuming oil, and therefore the demand is expected to be down by a quarter, which is about 25 million barrels a day. To just put that number in context, that's approximately what OPEC countries produce every day, or it's what US, Mexico and Canada, if they abruptly stop consuming oil today together, and that's the number we are talking about. So we are going to be seeing a significant demand contraction led by an output contraction. But what is really causing the second problem is the untimely price war that is happening between Saudi Arabia and Russia. Now remember, Saudi Arabia is the face of OPEC, and Russia is an outside partner to OPEC, and together with Russia, OPEC has been controlling the damage to the oil market done by the shale actors in US. So every time whenever the oil price falls, the OPEC plus Russia undergoes a production cut and tries to prop up the oil price. But then what happens is, when you do a production cut, you also cede market share, and this market share is directly grabbed by shale producers. So Saudi Arabia doesn't want to be playing this game forever, whereby it keeps ceding the market share to the advantage of shale producers only to defend the price. So this time around, they said or requested Russia to actually share the burden of production cut. It should not be all on OPEC, but it should be jointly shared by Russia, and Russia refused to reduce the production any further, because that will impact their income. So then Saudi Arabia very unexpectedly went on the offensive and said that, okay, instead of reducing the production, I'm going to actually open the tap and increase the production. And moment they announced this, oil prices collapsed, and what a worst timing for this price war to happen between Saudi Arabia and Russia. So these two factors, a huge demand contraction thanks to coronavirus and a ugly price war between Saudi Arabia and Russia, ensured that oil prices fell from the levels of $65 to about $20. Yesterday, Trump announced that he is going to bring both Saudi Arabia and Russia to the table in terms of some agreement. So celebrating that news, the oil prices again went back quite considerably, but then this is a volatile time and therefore don't expect any steady pattern on anything. But a very low oil price would mean that today's less production would create huge volatility for tomorrow's demand. So that's on the oil side. So a low oil price, how GCC economies are structured to withstand a low oil price? I think this is a very, very important question to ask. Now, if you look at GCC today in 2019 as compared to say 2013, the GCC economies non-oil growth, which is the real indication for economic prosperity, has fallen from 6.3 to 2.4, and they are reasonably okay in terms of reserves, but they have very low current account balance. They are ramping up their debt. They are very low on fiscal balance, and they are ramping up again on public debt. The public debt has skyrocketed from 9.4% to 30%, whereas the external debt is about 58%. Now, if you compare, for example, US or emerging markets, these are still reasonable numbers to look at. So they are not alarming, but definitely a very high debt ratio combined with the low twin account balances gives you less headroom to manage the problem compared to what you were enjoying before. Definitely we are talking about some impact on the businesses, but then there are sectors which will be adversely affected, like tourism, aviation, manufacturing, oil and gas, and consumer services. Technology will be mixed, whereas there are resilient sectors like telecom and healthcare. So what is very important to understand from a sector perspective or a business perspective is to see what is the depth of disruption and what is the length of disruption, and therefore what will be the ideal shape of recovery. The depth of disruption would be a factor of your reluctance to travel again when the doors are open, your reluctance to spend on consumer durables, and the way you socially interact itself will change. So that will be a very, very important problem to consider. The length of the disruption is a function of how much credit defaults happen, what type of PMI numbers are coming out, and the unemployment numbers are coming out. So the shape of the recovery, of course, we want a V recovery, but it can be a U recovery. So we need to be prepared for both. Aviation is the hardest hit, and we all know that, we have already seen that the estimated recovery could be as late as Q3 2021 for most of the airlines. It is the sector that has shown an immediate drop as a consequence of the coronavirus. It's the hardest hit. Tourism is, of course, hit really very hard. Now, because of cancellation of several events, there is a nice table here that shows the tourism share of exports and the tourism share of world tourism receipts. You can see that Italy has an 8% share of exports thanks to tourism, US about 10%, and Spain about 16%, and these are three very hard hit countries in the coronavirus. So expect tourism to be bleeding for some more time. You can see here a list of cancelled events, and I mean this is an easy call to make. You can say that almost everything is cancelled, so you don't have to show individually which events are cancelled, because as of now nothing is happening. But on the manufacturing side, the disruption is a bit tricky to understand, because as I explained, the pasta example, the manufacturing starts with the raw material suppliers, then you have end-tier suppliers, then you have the module or component suppliers, and then you have the OEMs or the systems integrator, and finally you have the distribution and the retail. As I explained before, the current disruption is heavily felt at the distribution retail end, but don't underestimate this seeping back one thing, reverse engineering, and then you can go and hit all the way up to the raw material suppliers level. The telecom is probably the silver lining here, because it increases the traffic in these times when people are heavily dependent on internet and telephone to keep up the business running. You already saw 50% uptake in mobile voice services, 5x increase in the traffic, and they provide mission critical service to business, so they will definitely benefit from this crisis. Healthcare could also be a beneficiary. Whenever we saw epidemics coming and hitting the world, we see a spike in health insurance premium as well. So there is a survey that was conducted in US where they said that people responded by saying that apart from savings and spending on organic food, they will also spend money on preventive healthcare and vitamins and supplements. So healthcare will be definitely be benefiting. Now that's on the economy and the business. I will quickly spend some few minutes on the capital markets, because many of us would have our personal savings here, and also we'll be managing the corporate money in some form or other as CFOs or investment managers and what have you. Globally, it's very, very surprising to see that the worst affected market happens to be India, and the least affected market happens to be China. Remember, China was the originator of this problem, and India numbers look very casual at the moment to trigger this sort of a stock market collapse. Indian numbers are not as scary as Italy or France or US or UK, but then its stock market took the biggest beating so far. That shows the institutional dependence of the Indian markets. When foreign institutional investors exit the market falls. And sector-wise, of course, the energy sector is the worst performing sector. And the healthcare and non-cyclicals are reasonably better compared to this. What is very interesting is also to see the impact on treasury bond yields and spreads. So the bond yields have come to almost zero. We will see some statistics as we go, and this has spiked the spread that the high yield enjoys with the treasury, and then you have one of the highest spikes in recent memory in terms of the spread. On the commodity side, the gold is a safe haven during times like this, so it's up by 5%. The Bitcoin is down by about 8%, but the biggest casualty of this is the oil price, which is now down by about 62%. We've already seen some statistics relating to oil. In terms of GCC markets, Dubai is the worst hit, followed by Abu Dhabi, and you can see that S&P GCC is down by about 25% so far. The CDS spreads, which talks about cost of insuring defaults, in fact spiked up tremendously to hit the higher end, but now they are all reverting somewhat back, but even now it continues to be at very elevated levels, as opposed to the global market where energy was the worst sector. In the GCC, it is the real estate that's the worst sector performing, and non-cyclicals have escaped the wrath. And we also measure the volatility index like VIX. We have something called as Marcus Volatility Index that we compute, and you can see that there is a inverse correlation between volatility and the market performance. So it's a negative market all over the world. But in this negative scenario, Asia is relatively doing better, because most of the Asian companies are holding better cash compared to European groups. So their share fall has been, in the sell-off, has been a bit better compared to the European sell-off. But that's a very small consolation in the bigger scheme of things. I wanted to focus on the bond yields. Look at carefully how the bond yields fell. For example, the US Treasury yield for 3 months fell from 1.6% on 14th of February to about 0% today. So across the spectrum, across the maturity spectrum, from 3 months all the way to 30 years, you can see that the yield has been falling tremendously, with the slope of the yield increasing and the spread also increasing. We saw that today, if you see at the lowest end of the spectrum, which is the CCC rated bonds, you can see that the yield has spiked, from nearly 11% to about 20%. So that's the return that investors demand to take the risk of bonds. So it's definitely not only the equity markets that bore the brunt, it's also the fixed income market that bore the brunt. So the question is, what should investors do? Now, here is a very unique crisis, which for the first time in the peacetime, not the wartime, the peacetime, that we have observed a simultaneous disruption both on the supply end as well as on the demand end. So we have never experienced this problem of twin disruption on supply and demand before. So definitely we have to see intended consequences and also the unintended consequences of this episode. What is really happening is, in this situation, if you see, the markets have turned extremely volatile. Now, there is a good measure to look at volatility, which is VIX. VIX on a normal world will hover around 8 to 15, and today VIX is about 80. So you can see that it is now a very normal thing in the stock market to see a 5% gyration, which is very unusual. So either it can be minus 5% or plus 5%. Depending on the day, the news of the day. So when volatility is so high, so what should investors do? The ideal advice when the volatility spikes so high is just don't do anything, stand there, because you cannot win playing volatility. There is no point getting out of stocks because the prices are already down 30% from their all-time highs, nor you should buy very aggressively because of very high volatility. So unless you are a professional volatility trader, don't do anything as of now and observe volatility. And once volatility comes back even to the 20s and 30s in terms of VIX from the 80s that you are seeing now, then probably you can think about long-term investing. This is a Minsky movement, and the recovery is going to be taking much longer than anticipated, because the damage that it has done to the markets will itself act as a barrier for high stock prices, because the heavy lifters and the job creators have been decimated in this, and they are the most productive part of the society, and they have been thrown under the bus. And therefore any remedies or solutions that we pursue will be a huge call on them, and it will squarely fall on their backs. So the government should come and completely support them. This comes on the back of years of malinvestment and over leverage. Remember, from 2008, when the global financial crisis came, till today, the world has gone on leveraging thanks to almost zero cost of funds. So with that high leverage and mal investment, things are going to get really worse as we speak. So as they say, don't try to catch a falling knife, definitely when volatility is very high. So this is a very important aspect to look at. So that's the second part of my presentation, and now I will move to the third part, which is the visualizing a non-COVID world, and how do we go from here. Before we get into that, it depends on how countries are managing the problem. As I see, there are three varieties of management here. The first technique seems to be social distancing and compulsory lockdowns. India is a classic example where the whole country is completely locked down, and and the country is advocating very strong social distancing, and they are experimenting with this solution for the problem. And then you have the second variety, which is not a complete lockdown. It's a mild restriction and business as usual, but with other techniques on hand. And then the third aspect are the countries that relies heavily on testing, and GCC is one of them. So we'll see how the whole thing, how these three models are very different from each other. For example, social distancing. I think there is a fantastic case study about the flu deaths that happened in 1918 in US. It's the case between, say, the distinction between Philadelphia and St. Louis. Now, this is a very celebrated case study because in the case of Philadelphia, the first flu death or pandemic came to their notice in September 17, and they started enacting in October. But then it was, by the time they enacted the social distancing, they were late on the curve, and therefore you can see the spike in the Philadelphia as the deaths as a result of the flu. But whereas in the case of St. Louis, they have taken the social distancing measure far ahead or far before the problem, and therefore they have experienced a flattened curve. So social distancing flattens the curve. Early social distancing flattens the curve really nicely, but then moment you free the flow social distancing, there is a risk that the curve can come back. Now let's see the three models. The first model is the complete lockdown, and this is where China has experimented with a complete lockdown, and you can see how they have really contained the problem within 2 months. The next example is the business as usual with mild restriction. Not many people are focusing on these two countries, which is Germany and Sweden. Sweden especially is a standout in Europe. Though their neighbors like Denmark and Norway went into a complete lockdown, Sweden shut only high schools and colleges, and they even allowed pubs and restaurants to function as we speak. So they are experimenting with a very different approach to managing the problem. And the third aspect are the countries that rely heavily on testing. And here South Korea scores the highest in terms of the number of tests conducted. They conducted nearly 3 million tests so far, followed by Germany and Russia. So you can see that countries, it's very heartening to see UAE here high on total tests performed per million people, whereas India ranks the lowest in terms of the number of tests performed. Remember earlier we started this discussion as to what are the factors that could explain the whole thing, and I picked up testing as the most important aspect. So the countries that do extensive testing are definitely can manage the problem much better than countries which do not rely very heavily on testing. They may not rely on testing not because they don't believe testing is important, but because they simply may not have enough testing kits given the size of the population that we are talking about. So definitely it worked for South Korea. phenomenally well, and they've almost flattened the curve as we speak. And let us see which of the three methods prove to be the most effective. In terms of policy interventions, there are two ways to do that. One is through banks. We can think about bank supported lending. We can postpone the EMI payments. We can provide reliefs to credit card debts, and there are many ways banks can help. But the government is the most important actor here. It's the government that can really take the heavy lifting. The world, remember, whenever we have a crisis, we have solutions from a monetary policy and solutions from a fiscal policy. The world for the last few decades have been busy on the monetary policy. So whenever we have a crisis, we see the Fed slashing the rate, and but now almost every part of the world is at a 0% interest rate. So you can only go negative from here. So there is little headroom to do on the monetary side. So that means the drama has to shift to the fiscal side, and the fiscal side is a government thing, and the government can do so many things, and as we speak they are announcing a lot of stimulus package. We are going to be seeing how much it is, and this is a problem that the government has to be in the front, loud and clear. So we are seeing that the US has unveiled one of the biggest stimulus package of about 2.2 trillion, which distributes among government entities, hospitals, small businesses, individuals, and what have you. It's the largest ever in the peacetime stimulus program that one has seen, and we have also seen almost every country announcing some sort of a stimulus package, and this is the only solution to this huge problem. Now, visualizing a non-COVID world is a bit tricky in terms of how long this is going to last. Now, first of all, do we have any clear benchmark to look at? We do have some benchmark. Remember the graph where we have shown how severe this COVID is when compared to the other epidemics. But then let us take, for example, SARS. SARS was discovered first in November 2002, and then it went through a series of stages, and by July 2003, which is about say 7 months, the World Health Organization declared the end of the pandemic. Now here we are, we started the problem in December 2019, and we are clearly about 3 months into the problem, and the question is, how long is this going to be? That's the important question to ask. So there are 2 or 3 scenarios, I would say. The first scenario is that world over countries are effective in flattening the curve through lockdowns, and then they can easily maintain a very low case after easing down the regulations. If this is the scenario, then we are talking about a 4 to 6 month impact, and we are already 3 months into the game, so we have another 3 months to go in terms of estimating the problem. However, if it's not as simple as that, and if the effect of virus is due to factors like mutation, seasonality, or new treatment, then you're talking about a scenario which can extend about 6 to 12 months impact. And if the mutations and seasonality, or if you don't discover any vaccine for the problem, then you're talking about a very worst case scenario of a 12-month impact. Now, what is mutation? Mutation is the virus itself mutates on its own, and therefore it becomes ineffective. Or there is a theory that says that seasonality plays a very big part in this virus spread. So as the northern hemisphere enters into a summer, the virus spread will be contained thanks to the seasonality. Or we are lucky to discover a vaccine that can cure this flu or a virus. So if that happens, then you're talking about a 6 to 12 months. But if none of this happens, if, like, for example, the virus doesn't mutate and there is no seasonality impact, or we haven't found a vaccine, then we are clearly talking about a scenario which is more than 12 months from this point of view. So how would this change the course? We are also having the risk of the infection coming back. Everybody is now thinking that it's down and dusted in China. What if it comes back again? Because China is a huge country, and most of the EU countries and US are still experiencing an exponential growth, as we saw in the dashboard. It depends on how quickly they control that exponential growth. And even patients that have recovered completely might have some residual traces that can infect others. As I explained, mutation, seasonality, and vaccine are also very important to talk about. So let's see what would be the business impact under these three scenarios. Scenario 1 is the best case scenario, so it's color coded in green. So a mild recession, you will have 2 to 3 quarters of earnings impact. Supply chain shocks will be temporary. Sectors like travel, hospitality, aviation will feel the pain, but then there are other sectors that will completely recover quickly. And this, augmented with stimulus by central banks and governments, should basically clear the air. All of us want this scenario to happen. The second scenario is a moderate to severe recession in deeply affected countries. We have already seen Italy, we have seen Spain, we have seen US, and this will definitely affect consumer demand and confidence, most importantly. Supply chain will not be that easy to come back, because we have seen that there will be a reverse impact on the supply chain. Smaller businesses definitely would not survive under this impact, and government intervention is going to be long and deep. And the third scenario, which is the worst scenario to imagine, is a global recession moving well into 2021. A lot of sectors will be affected, and the government has to establish a cycle of lockdowns and relaxation. And so it is not that there is a lockdown and then everything is clear. No, there will be relaxation, and again there will be a lockdown, and again there will be a relaxation. So this is the worst scenario to imagine. How do we put a finger on the timeline? If scenario 1 it's contained soon, then life will be normal by the 4th quarter of 2020 or 3rd quarter, as we see in some parts of the world. In the Eurozone, probably it will take a bit longer, say Q1 2021. But if recovery is muted, the worst case scenario happens, then you're talking about a recovery time as deep as 2022 or 2023. So it's not a very easy answer as to which scenario is more palpable, because things change by the minute as we speak. There are so many unknowns here, so we will not be able to really answer that question, but we can probably come closer to our estimate as more information comes, and there is no more rationalization of how the statistics is captured and understood. So there is the extent of statistics and the reliability of statistics. Both seem to be a very important thing. So finally, these are my final thoughts. As we stand today, we still are experiencing an exponential growth in cases reported. We still have no clarity on how this will plan out. Oil price war is coming at the worst time that we can imagine. the next few weeks are going to be very critical. The businesses will be severely impacted. Transport, manufacturing, and tourism will face the grunt, but healthcare, technology, and telecom may benefit. Social distancing and lockdowns are showing positive results, but what can really stop the virus from spreading is very, very aggressive testing and isolation, and that's a question of how well are you endowed in terms of your testing kits. And the government has announced several stimulus measures. This is a problem which can only be tackled through fiscal measures and not through monetary measures. And recovery will definitely be there, but it depends on if scenario 1, you're talking about end of this year. If it is scenario 3, we are talking about 2023. In terms of capital market, definitely these are great times for investors with the new money, but I would like to caution that as long as volatility is very high, it won't present any opportunity. Only when volatility calms down, then you can really go after quality companies and establish your portfolio for buying. So that pretty much concludes my presentation. Let me check on what type of questions do we have, and I will take some of them. What kind of behavioral changes will come about in a non-COVID world? I think a non-COVID world will be a very fearful world from a behavioral point of view. The risk de-risking will be very high, and risk taking will come down. Risk management will come to the fore, and people will be very ultra cautious in my view. There is a question which asks if normalcy can come in June. If not, what is going to happen for the global economy? I think I answered that question. There are too many questions to look at, but let me quickly see a few words on the long-term impact on gold and silver prices. Definitely gold is always a safe haven in times like this. So gold is actually not, in my view, it's not an asset class. It's basically an insurance for your portfolio. And definitely it is one of the few places behind which you can hide. I don't have much view on silver, but the gold definitely is. There is a question on where do you see Indian markets bottoming out, whether we should wait for the first quarter results to invest. As I said, the key here is not about the market levels, but about volatility. You need to wait till the volatility subsides. And once the volatility subsides, then you can definitely do some quality buying. Views on the oil truce called by Trump with Putin and MBS with an OPEC meeting scheduled. Do you feel the 10 million cut will suffice, or 20 million is needed to stabilize oil prices? I think oil prices today is more about demand destruction than about supply management. Of course, the opening of the tap by Saudi Arabia comes at an extremely wrong time. But even assuming that they close the tap and take the oil out of the market, remember the world storage is brimming and flowing, and there is no demand. So if you are talking about a 25% cut in demand, that is enough to keep the oil prices low for some time to come. When we talk about tests per million, where Swiss is doing well, are these tests asymptomatic tests or symptomatic tests? I think there are two types of tests that you can do. You can do the testing based on symptoms, and you can also do the testing based on a random selection of the population. Countries that are very high on test per million adopt the random testing process. They don't wait for the symptoms to show up. Whereas countries that are too big in terms of population, like India, definitely would have to go by symptoms because there are just too many people to test actually. If this continues for the next few months in Europe and US, what's your call on real estate investments across the jurisdiction? I would definitely play safe and not venture into any real estate investments at this point in time. I think the best thing to do is to stay in cash in times like this. Scenarios, I've already laid out some scenarios. Do you think Kuwait will need to borrow from the international markets immediately, or can they tap into their reserves for a while? They have a lot of reserves to tap, but the question is, when the interest rates are so low, why not borrow when your credit rating is so good? So this is the question. Kuwait has been constrained from borrowing in the international markets because they couldn't pass a debt law in the parliament, but now the slew of reforms will hit Kuwait and other GCC countries, and you can see that GCC countries aggressively tap the international markets once normalcy returns. But obviously Kuwait can also do with the reserves because they are endowed with plenty of them actually. The government stimulus, are they enough? Definitely they are not enough. They can never be enough in a situation like this where the damage is so huge, but they are the only choice available to us. So how do you bring demand back into the system? How do you encourage consumers to spend? How do you encourage business to invest? How do you bring the confidence back? Someone has to be in the front and leading, and only government can do that. So definitely I see a government playing a huge role, and the government maturity will come to test in most of the markets, and we'll see that it's a very, very important thing to play. I will stop here because I see a long list of questions. I'm happy to. I have your email IDs here, as I can see. Maybe if you can, Sai can connect both of us, and I'll be happy to. You can shoot a question on the email, and I'll be very happy to answer. I am as much an observer as all of you in these testing times. We are definitely being challenged from many quarters and angles. One important positive that I see in the whole thing is that this crisis will definitely trigger unimaginable reforms in many countries, including India. The reforms will be centered in critical sectors like healthcare and manufacturing, and that is going to be a huge plus for the next decade, because it's the lack of reforms that impedes a society from growing. So a crisis of this magnitude will make anyone take a complete relook about everything. And I'm sure, especially I'm talking about the GCC, where sustainability of our economies has always been a big question given our huge oil dependency. And this time around, I think the message is loud and clear. And I mean, the dust will settle down maybe in 3 months' time, 6 months' time, 12 months' time. After that, I think the focus will entirely shift to reforms. So it will be very interesting to observe these reforms and then connect the dots to businesses and investments. I think that's the biggest takeaway in this whole crisis. So once again, I hope I haven't taken too much of your time. I wish I could have answered all the questions, but I don't want to be too long as well. So if you still have some questions, or if you need a copy of this presentation, please contact the CA chapter of Kuwait. I have to again thank the CA chapter of Kuwait for inviting me to do this webinar. Thank you, Sai. Thank you, the executive committee members. You've been great friends all the time. So stay safe and make full use of this pause in our life. Read a lot of books and share your knowledge with your professional colleagues. Good afternoon. Thank you.